Buying and selling options without understanding the underlying math is indistinguishable from pulling a lever on a slot machine. You might win occasionally, but the mechanics controlling your money remain entirely out of your hands. But the market provides a way to convert those mysterious pricing forces into exact, predictable estimates. We use a dashboard of metrics known as the Greeks. Think of them as the instruments keeping your car on the road: a speedometer, an accelerator, a fuel gauge, and an engine temperature gauge. In a trading interface, these appear as delta, gamma, theta, and vega. Before we read the dashboard, we have to establish one mathematical rule. Because a single option contract controls 100 shares of stock, prices are quoted on a per-share basis. So a $5 quoted price actually requires an outlay of $500. To keep the math clear today, we will use that base $5 format on screen. Mastering this dashboard is how you predict exactly how much money a specific position will make or lose across different scenarios, long before the market even opens. Let's start with the speedometer, delta. Looking at this ledger, we have a call option priced at $5, a stock at $100, and a blue delta value of 0.50. Delta is the estimated change in the option's price for every $1 move in the stock. If the stock ticks up to $101, we add that 0.50 delta, making the option worth $5.50. Put options work differently, using a double negative logic. Here, we have a put priced at $5 with a delta of negative 0.25. Because puts profit when the stock falls, a $1 drop to 99 activates that negative delta. The loss in the stock cancels out the negative sign, adding 25 cents to make the new price $5.25. Now we introduce the accelerator, gamma. Returning to our call option, we are introducing an orange gamma value of 0.10. Gamma measures the rate of change of delta itself. For that next $1 move, the 0.10 gamma combines with our previous delta, creating a new, faster delta of 0.60. That larger delta is what adds to the $5.50 price, bringing the new total to $6.10. Delta tells you your current momentum. Gamma tells you how aggressively that momentum accelerates if the stock continues to run in your favor. Let's test this logic. We have a put option currently priced at $5.25, a delta of negative 0.25, and a gamma of 0.05. Pause the video right now. If the stock drops by another single dollar, what is the new delta and what is the new option price? Here is the step-by-step solution. The positive 0.05 gamma softens the negative delta to negative 0.20. This means the second $1 drop adds only 20 cents to the option's value, resulting in a final price of $5.45. We can now step away from stock price movements entirely to look at the fuel gauge, theta. Displayed here as a red negative 0.10, theta is the amount of extrinsic value the option simply bleeds out every single day it is held. If the stock price doesn't move at all, one day passes and the price drops to $2.40. If we fast forward 4 more days, that red theta continuously drains the premium down to $2.10. This creates a harsh reality for option buyers. Because theta decays the contract's value, you are locked in a mathematical battle against the clock. Being right about the direction of a stock too slowly is the exact same thing as being wrong. Finally, we check the engine temperature, Vega. Represented by this purple Vega value of 0.25, this metric calculates how sensitive the option's price is to a 1% shift in implied volatility, or IV. If implied volatility moves from 25 to 26%, we add the 0.25 Vega directly to the option's value, taking the price from $2.50 to $2.75. A common misconception is that implied volatility is an invisible force actively pushing the price around. It is the opposite. A surge in market demand is what drives the option's price up. The IV percentage simply updates to reflect that frenzy. Vega measures how drastically market hype or panic will inflate or deflate your premium, operating completely independently of what the underlying stock price is doing. In a real overnight hold, all of these forces hit the contract at the exact same time. Let's look at a scenario where the stock goes up, 24 hours pass, and post-earnings demand plummets simultaneously. It is a mathematical tug of war. Your blue delta tries to pull the price higher into profitability, but the red overnight theta decay and the crushing purple drop in Vega actively fight to drag your gains back down. Here is the summary table defining these mechanics. Delta measures directional exposure. Gamma measures the rate of delta's change. Theta measures daily time decay, and Vega measures price sensitivity to implied volatility. Pause the video and take a screenshot of this table so you can reference it alongside your trading interface. Rigorously checking these 4 metrics before executing a trade is what separates professional risk managers predicting exact outcomes from retail traders hoping for the best.